What is a bear market and how does it relate to recession? Imagine walking into a store where everything is on sale, but instead of feeling excited, you feel worried about what's coming next. That's kind of what a bear market feels like in the world of finance. A bear market is when stock prices are falling and investors start feeling less confident. Specifically, it happens when a broad market index like the Standard & Poor's 500 or the Dow Jones Industrial Average drops by 20% or more from its recent high. This decline usually lasts for at least 2 months. Now, the opposite of a bear market is a bull market, which is when stock prices are rising and people are feeling optimistic. When prices fall in a bear market, many investors become pessimistic about the economy's future. They start selling their stocks, which makes prices drop even more. Sometimes, even good news gets ignored because everyone is worried. The market can stay in a bear phase until prices become low enough that some investors see them as bargains and start buying again. This cycle can be stressful, but it's a normal part of how markets work. Bear markets can affect the entire stock market or just some individual stocks. When almost all stocks are falling, it's called a broad market decline. This is different from a market correction, which is a smaller drop of about 10 to 20% and usually lasts a shorter time. Bear markets tend to be more severe and can last 4 months or even years, though on average they last about 9 months. So, how does a bear market connect to a recession? A recession is when the economy shrinks 4 consecutive quarters, meaning 6 months or more. During a recession, people often lose jobs, businesses make less money, and people spend less money overall. When the economy slows down, investors worry about the future, and that can cause stock prices to fall, leading to a bear market. But it's important to remember that not every bear market means a recession is happening. Sometimes stocks fall because of other reasons like changes in government policies, global events, or shifts in how investors feel. Likewise, not every recession causes a bear market. Sometimes the economy shrinks without a big drop in stock prices. When a recession does happen, it often leads to a bear market because economic troubles make investors nervous. They sell stocks to avoid losing more money, which pushes prices even lower. This connection between economic health and stock prices is why many people watch both indicators closely. For everyday people, a bear market can be tough. Stock prices falling can make investors worried about their savings. It can also make people hesitant to spend money, which can slow down the economy even more. But history shows that markets usually recover after a bear market, and the economy eventually bounces back too. In simple terms, a bear market is a period of falling stock prices that often, but not always, happens during or after a recession. It's a sign that economic confidence is low, but it's also part of the natural cycle of markets. Knowing this helps us understand why markets go up and down and how they relate to the bigger picture of society and history.